Hi everybody, and welcome back to video number 2 in chapter 19. And when we left off, we were illustrating a very important point as how absorption costing can drive up income simply by producing units here at 100,000 units produced. We still only sold 60,000 units, but our full absorption costing of $820,000 is substantially more than $580,000. And if you're getting a bonus based on net income, there is a temptation to overproduce as a result. So, income under variable costing, though, is quite a little bit different. Here, we walk through our full absorption costing, and it's $580,000. But under variable costing for 100,000 units produced, you can see that we still only made $580,000, the same as we did as if we had produced the same as what we sold. Very important concept. Why? Because we're not hiding any fixed costs at this point in time. I use the term hiding, but we're not waiting until we sell those fixed costs to record those fixed cost amounts. Okay, so we can now determine product selling price and analyze special orders, and it's very useful to base it on our variable costing. There's a three-step process to determine the selling price. One, determining the product cost per unit using absorption costing. Number two, determine the target markup on product cost per unit. Number three, add the target markup to the product cost to find the target selling price. So let's see how we would do that. Here's our absorption cost per unit. Here's our target markup, and that's 60% markup, or 60% of $25 is $15. So our target selling price per unit would be $40 in this example. Now, special orders, we need to cover all the fixed and variable costs over the long run. But since fixed costs don't change, we should accept special orders if the price exceeds the variable costs over the short run. And of course, we don't think that there's going to be any publicity of the fact we're giving a special deal away. So here's our sales at $22 per unit. You'll remember that we were selling it here for our cost would be $25 per unit. So here we're dropping that down to $17 per unit and accepting a sales price of $22 per unit. Now, $22 per unit is less than the full absorption costing of $25 per unit, but we would still make $5,000 on this deal, and so we should accept the deal if there's capacity and we don't think that it will affect our normal orders costs. All right. So we can also use variable costing for services. Here our revenue was $35,000. The variable costs were $30,000. So our contribution margin is $5,000. So here we have 120 flights at $50,000 per flight. Airplanes are expensive. So we have $6 million in revenue here. But our wages, fuel and oil, food and beverage total $3.6 million. So our contribution margin is $2.4 million. But we have some depreciation and some rent. It's fixed expenses, for $720,000. That gives us income of $1,680,000. All right, now, how do we apply the contribution margin ratio for business decisions? So the contribution margin ratio is, as we know, the contribution margin divided by our net sales. So it's the percent of sales that remain after we have subtracted out the variable expenses. So here's an example of that. Western Territory and Eastern Territory, both selling $1.2 million. Now, the variable costs are the same here, but the variable selling and administrative expenses are a little bit different. We have 30,000 times 260 here, and we have 30,000 times $1.40 here. So the contribution margin is a little bit different for Western than for Eastern. And the contribution margin for Western is 56%. That, of course, is $672,000 divided by 1.2 million. But Eastern territories, that's going to be 59%, a little bit better than Western territories. And it's computed by taking $708,000 and dividing that by $1.2 million. So an analysis of contribution margin by product line can impact managerial's decisions. It can result in increasing the selling price per unit or decreasing the variable cost of goods sold per unit, and maybe even increasing our selling efforts. So here we have a situation where hockey skates and figure skates are sold for the same amount of money, slightly different variable costs for the hockey skates versus the figure skates. So at the bottom line here, our contribution margin for hockey skates is 60% and figure skates is 55%. Naturally, we want to focus on selling hockey skates versus figure skates because we make more money per pair of selling these skates. All right, now we're going to take a look at converting income under variable costing to income under absorption costing. So this is a key concept. And what we want to do here, we must use absorption costing for external reporting and tax reporting. But income under variable costing is restated to that under absorption costing utilizing the following formula. So income under absorption costing is equal to income under variable costing plus the fixed overhead in ending inventory minus the fixed overhead beginning fixed inventory. So finished goods inventory is beginning is subtracted, ending is added. So we're looking for that change. Okay, so here in the first year we had variable costing, which we just went through in the previous slide, and we made $580,000. But in year two, we sold less than what we manufactured. So the 20,000 unit difference in what we sold versus what we produced is multiplied by the per unit fixed cost of $10. That gives me $200,000. And in the last year, the same thing, except we go the other way with it because fixed overhead and beginning inventory was $200,000. So as you can see, I like to use the term hiding 200,000 fixed overhead in finished goods inventory in year 2 that we have not expensed through cost of goods sold yet. Whereas in year 3, we do expense that. Okay. Okay, that ends chapter 19. And when we continue, we'll take a look at chapter 20. Until that time, bye for now.